Unless you're living under a rock, you should know that the Federal Reserve is printing a lot of money over the past few months. Ultimately, the money printing of the Federal Reserve has increased the financial assets and is on the way toward an unprecedented situation. The founder and CIO of Bridgewater Associates, the biggest hedge fund in the world, Ray Dalio, recently mentioned how the Fed has forced the financial markets into a corner. Dalio is experienced in macroeconomics, which has assisted him in successfully managing $150 billion during the past few decades. Due to his expertise, many countries have visited Dalio for his economic insight. This video will go deep into the subject of the changes in the economic landscape and how the Fed might have just trapped itself in an unprecedented way. Welcome to the Bulls and Bears channel. If you're new to the channel, hit the like button and subscribe to the channel if you enjoy our content. Now let's go back to the video. Before we continue, do take note that this isn't going to be a doom and gloom video that tells you that a crash is coming on a specific date and time. Properly determining market crashes is impossible, and I'm not here to spread fear. With that said, our situation today is extremely strange and would lead to very important implications. Over the past months, the Federal Reserve is implementing high levels of quantitative easing, or basically, the buying of huge amounts of bonds. The extra buying power of the government has resulted in the artificial inflation of bond prices. As a few of you might already know, bond yields and bond prices are inversely related. When bond prices increase, bond yields decrease, and when bond yields increase, bond prices decrease. As a result, bond yields are currently suppressed to very low levels. To date, the 10-year Treasury yield is around 1.5%. At the same time, the inflation rate is a lot higher than 2%. So while bond investors think they're going to make money, in reality, the real returns are negative. The returns prior to inflation, called nominal returns, are positive at 1.5% per year, but the returns that account for inflation, called real returns, are actually negative. Due to this, bonds are not a good financial instrument to be investing in right now. It would be more logical for the Federal Reserve to sell some of its bonds to fight off the artificially high bond prices. Currently, the Fed has made the decision to start selling off corporate bonds and corporate bond ETFs that they bought during the pandemic. The Fed has also started discussions of slowing down their bond purchases. With this information, you might think that the Fed might be slowing down its bond purchases. However, Ray Dalio thinks differently. He thinks that the Feds would be buying more bonds than selling them. It might sound crazy in the beginning, but when you look deeper, it really makes a lot of sense. Bonds are really not a good investment to buy right now. A reason for the high prices in bonds is because large institutions bought a lot of Treasury bonds to stay conservative. That way, if the pandemic gets worse, these institutions can sell their bonds to keep their businesses afloat. As soon as these large institutions and investors start to sell their bonds to buy other financial assets like real estate, domestic stocks, and international stocks, the prices of the bonds would collapse. This is because no one wants to purchase bonds when there are inflationary pressures, because the inflation on the bonds guarantees net loss returns at the current rate. Also, other financial assets have the possibility for a high return on investment. The Fed will have to purchase bonds to artificially increase the money supply and prevent a crash in bond prices. So instead of slowly selling, the Fed will have to continue to purchase bonds to inflate the bond prices and create more inflation in the financial markets. The consistent increase in money supply to inflate the market is called monetary inflation. The Fed can't just let the interest rates increase. This would lead to a crash of all financial assets, which is why Dalio stated that the Fed will need to purchase bonds to prevent this scenario from happening. Dalio believes that investors can make a lot of profit before the crash happens by investing in Chinese-related assets. The pandemic hit the US hard, while China has already recovered from it. As a result, there was a high demand, so US companies began importing more Chinese goods. This has then led to an uneven balance of payments in both countries. Every country has a balance of payments that shows their international transactions. A balance of payment has two parts: the current account and the financial account. The current account involves all international trade of goods and services, together with transfer payments. The financial account involves investment in foreign financial assets, like stocks. Because China is exporting a lot of goods to the US, its current account is a surplus. This means that China has a huge supply of US dollars. These dollars will be used for importing US goods to China, investing in US financial assets, or converting the US dollar to the Chinese yuan. Either way, the US dollar should appreciate when compared to the Chinese dollar, because when Chinese companies use their US dollars to buy goods or financial assets, this results in the depreciation of the US dollar because of the increasing money supply. Also, if there is a surplus of US dollars being converted to Chinese yuan, this would devalue the dollar. Due to the situation, Dalio thinks that Chinese assets are perfect for hedging against US dollar inflation. Dalio thinks we're in a bubble when it comes to the US financial assets. Because of the bubble, the stocks are trading at premium valuations, which makes it hard for investors to find different investment opportunities. The former Secretary of Treasury and current Harvard economics professor, Larry Summers, agrees with Dalio and explains how he sees a drastic change in the future of the economy. Larry likens our situation today to that of driving a car 100 miles per hour on an empty road. However, the road will not always be empty and will run into an accident as the car speeds on. As I stated earlier, this is not a doom and gloom video. Truth be told, there might not even be a market crash. The only thing that is clear right now is that lower long-term real returns in financial assets might be highly likely. Last year, people have experienced amazing capital gains. However, you should not expect these types of returns to continue for the general market. There will be some stocks that could go substantially higher in value, but those opportunities will be harder to find. This is due to the fact that when the prices of the assets increase, the expected rates of return decrease. The correlation between current prices and future returns in the stock market is inversely proportional. This is similar to higher bond prices having lower yields. In the same vein, when the stock market increases, the expected future rates of a specific term decreases. In general, financial assets will most likely have lower long-term real returns. In a time of complex macroeconomic environment, investing is more significant than ever. What do you think? Is Dalio correct? Should the Feds buy more bonds? Or was he wrong and the Feds should continue to sell their bonds? Let me know in the comments below. If you enjoyed this video, hit that subscribe button, click on the notification bell to be updated on our new videos, and don't forget to give us a like if you want more videos similar to this one. See you in our next video!